What is your goal when you send a valuation report to the Internal Revenue Service for a gift or estate tax matter? My goal has always been one of quiet acceptance. I hope that the report will be viewed as heavy, as well-written, as logical and good, and the Internal Revenue Service will say, ho-hum, another pass, and move on. And that's been the case with literally thousands of Mercer capital reports. Today's video, valuation video, is a tale of two tax court situations, two totally different situations. In the first situation, I did the original appraisal for an estate. The subject interest were four small minority interests in 4 New York City LLCs holding very attractive underlying real estate. So we sent a report in, and the report had a minority interest discount of 5% and a marketability discount of 50%. Now, before you go, whoa, let's talk just a little bit more. The Internal Revenue Service reviewed that report and issued a separate report, and their report basically said the minority interest discount would be 10%. I didn't argue with that. And that the discount for lack of marketability should be 15%. My total discounts were 52.5%, and theirs were 23.5%. So this is a classic dispute over really the marketability discount. So what were the issues? Well, the managing member of the LLC was a bad actor. He was literally trying to steal minority interests from lots of minority owners of these very attractive underlying real estate properties. There was ongoing litigation. The minority shareholders had been litigating for quite some time, and the shares that were the subject interest were in a trust to participate in the litigation. There were substantial accrued legal fees, but their total amount was not yet known, but it was known as a percentage of the ultimate settlement. The discount for lack of marketability was a real issue. There was an uncertain holding period. There was ongoing litigation. It was not settled. There was high risk, very high risk in this situation for any holder coming in to buy this stock. And there were negative distributions. In other words, they were either paying tax distributions only in a couple of them and not even tax distributions in the other two. So those were the issues. In terms of the Internal Revenue Service, there was absolutely a complete and utter failure to distinguish between the attractiveness of the underlying real estate and the unattractiveness of the subject interest. So what happened? I wrote a report that criticized the IRS report. The attorney for the estate used that report as a basis for discussion, and it must have been a pretty good valuation report and a pretty good rebuttal report, because they settled at a net discount of 49.65%. The client was happy, and I was certainly happy. It wasn't quiet acceptance, but it was basically a virtual acceptance of our report. The second case, I was not the original appraiser in this matter, but there were 4 S-Corp auto dealerships. They had been valued a couple of years ago, a few years ago, and the original appraiser was simply not available. So the counsel for the estate, for the taxpayer, made a gift, a substantial gift, called us, and we valued the companies. We valued 100% of the equity at $24.6 million. The Internal Revenue Service issued a report by an Internal Revenue Service appraiser at $29.7 million. My discount for lack of marketability, there were 4, so the blended marketability discount was 33%. Theirs was 25% across the board. And we had a non-marketable minority value of $16.5 million versus $22.3 million. This was not your basic dispute over a marketability discount. This was basically a blocking and tackling valuation situation. I call it valuation blocking and tackling. Their valuation report was not very good. Debt. We both used total capital as a vehicle to capitalize and get enterprise values, subtract debt, and add cash. Well, they used the debt from the wrong balance sheet dates. It's just wrong. They used non-operating assets from the wrong balance sheet dates. It was just wrong. They had forecasts that were simply unsupported, and when you graphed them out, bore no resemblance whatsoever with history. So they had that problem as well. And then, of course, the discount for lack of marketability, because there was no differentiation between the 4 S corps, and there were clear differentiations between them. Our marketability discounts range from 30 to 40%, and so the most attractive and biggest company had a 30% marketability discount. In any event, what happened? We sent this report to tax court, and we were scheduled to go to tax court. That I was sitting in my office on a Thursday afternoon, planning to go Sunday evening to tax court down in some city somewhere. And the attorney called and he said, hang it up, it has settled. Well, where did it settle? It settled after our rebuttal report, because the attorney had used that rebuttal report to discuss with the Internal Revenue Service. It settled at $17.7 million, or about 20% of the difference, of the nearly $6 million difference. It settled because I don't think the Internal Revenue Service wanted to go to court with that report. So in today's valuation video, we have a tale of 2 valuation disputes with the Internal Revenue Service. In the first, an original appraisal, we seek quiet acceptance and didn't get it, but we got acceptance. In the second, we were called to help take this case to tax court. We didn't get quiet acceptance, but we got pretty much acceptance. The client was happy, everybody was happy. What is your goal when you send a report to the Internal Revenue Service for gift or estate tax purposes? My goal is to have the best possible valuation report and earn the quiet acceptance of the Internal Revenue Service. This is Chris Mercer with one more valuation video. I look forward to talking to you again in the future.